Hello, everyone. Welcome to the Wharton Global High School Investment Competition Meet the Expert Series. We'd love for you to turn your cameras on and see you and say good afternoon, good evening, or good morning, depending on where you are in the world. I'm Eli Lesser, Executive Director of the Wharton Global Youth Program. Just a quick update on who we are. The Wharton Global Youth Program uses the opportunities of the Wharton academic community to educate, inform, and inspire pre-collegiate students just like you to explore business, finance in meaningful ways and become leaders that will transform the global economy. One of the things that makes this community here at the Wharton Global Youth Program so great is that you come from all over the world. So do us a favor, use that chat box and tell us where you're connecting from today. Just tell us maybe city, state, country. Tell us where you're connecting from today. We'd love to see it. I also want to take a second and talk to you about where we are. We're not in Zoom. We are currently sitting here at Huntsman Hall on Wharton's campus at the University of Pennsylvania in Philadelphia in the new Wharton Academic Virtual Environment, or what we call the Wave Room. We're going to show you what you look like right now. See that up on the screen. This room provides a unique and interactive experience for both our presenter, us, and you, the attendees. This is our first time having this many attendees join us, so we're thrilled to have you with us today. We have students from all over the world connecting with us here in the Wave Room on Wharton's campus in Philadelphia. Well, we're excited to bring back this exclusive opportunity for members of our Wharton Global High School Investment Competition, our Meet the Expert series. This is our third year running Meet the Expert series conversations, and they are a series of video discussions featuring finance and business experts who we find are connected to the Wharton School in many ways. While these discussions, quick disclaimer for all of you, are created specifically for you as investment competition participants, they are not designed to give any team a competitive advantage in the competition. They are really focused on helping you learn, explore other topics in business, and dig deeper into the competition itself. I want to also encourage you that we want you to participate. I'm going to share some questions with our guests, but I also want you to connect with us and share your questions. Use that Q&A box in the bottom. I'm going to start with some questions and then we'll bounce over to your questions and I'll be able to answer them. My team is standing by to feed me those questions as you submit. All right, let's jump in and meet our guest. Joining me today is Jeremy Schwartz, Wharton alum, class of 2003. He's also Global Chief Investment Officer for Wisdom Tree, an asset management firm that specializes in exchange-traded funds, or ETFs. Since 2014, Mr. Schwartz has co-hosted the Sirius XM program, Behind the Markets. You can find it if you tune into Sirius XM on channel 132. It's run probably during your school day, but we want you to encourage you to download the podcast, Behind the Markets, on any podcast provider that you use. Tune in every week for a new podcast with Jeremy and Jeremy Siegel as well, Wharton's world-renowned economist and Wharton Professor Emeritus Finance. Today, Mr. Schwartz is going to help us better understand ETFs, as well as to share some insights from his alliance with Professor Siegel, who is also the author of Stocks for the Long Run, a well-known book about stocks for market insiders. Before joining Wisdom Tree, Mr. Schwartz was Professor Siegel's head research assistant and helped with the research and writing of that book, Stocks for the Long Run. Jeremy Schwartz, welcome to the Wharton Global High School Investment Competition, Meet the Experts.
It is so great to be here. What a unique experience being in this room with you all on the wall here. It's great. Thanks for having me.
My pleasure. Before we jump into ETFs, so let's talk about Wharton a little bit. What brought you as a 17 or 18-year-old high school student to think about applying and then ultimately enrolling at the Wharton School?
It's interesting. I was always good at math. I sort of thought my dad would like to say he takes credit for where I went was he would show me the newspaper when I was 2 or 3 and he would go through the stock pages and he was into investing and he would have a set of stocks that we would talk about. And I sort of got a little bit of that from a young age. I did do an internship before I got here. And I sort of knew I wanted to do something in math. I didn't love English, but it's interesting how, so I applied early to Penn. I mean, I visited as an undergrad. I loved the experience. I loved the atmosphere, the environment, but also the business program here is sort of top of the world. So I thought it was a great opportunity to do that.
Did you know from the day you walked in the door that you were going to do finance? And did you ever explore other areas of business here at the Wharton School that you found fascinating?
It's interesting. I did not explore. I mean, I thought I would have an investment management career. So if I would have scripted it, it definitely does not always work this way. But if I thought I could script it, I wanted to be a portfolio manager. And basically, I lucked my way into that exact position. But, I one thing leads to another, but linking up with Siegel was what steered my course. But I did know I wanted to do something with investing, and the practical, how to become a better investor was always my goal.
So if we met high school age Jeremy Schwartz, would have loved the Wharton Global High School Investment Competition.
We did a stock trading program.
Okay.
I remember we did participate in the trading program. When I talked with your team about how this one was run, we were focused on the short term, which was how do you win over the next 3 months, or how do you pick the best stocks, which is probably the opposite of what you want to do over the long run. So I love the way this one is structured, but I did participate, and I think those kind of practical experiences is critical. So I love that you are all participating. I think it's the exact right type of experiences you all should be getting.
But to date myself too, I did a stock trading game when I was in school. I think I was in middle school actually at the time. And we used Scantron. You had to bubble in the stocks you wanted to buy, and then they sent you a newspaper. You had to check on it. Very old.
Yeah.
All right. So let's talk about it. You mentioned that when you got here, you met Professor Siegel. Tell us about how you made that connection, how you met him, and you developed that friendship and partnership.
It's always a small, you never know the littlest things, how much they matter. But there's something called the Dean's Advisory Board here at Penn. I happened to get on it from my Management 100 TA was on it. She got me on this board. And I was organizing these seminars with the professors, and I got to meet him through that. And one day, he didn't show up to a seminar that I was organizing. And I sent him this email, like, I hope you're okay. We missed you today. And he wasn't there, but the way I responded to him, and anyways, he liked me. I got into his class. I took his class for my sophomore summer, and I was supposed to go abroad to Australia, and I needed something to do for a few months. So I said, hey, can I work for free? Is there anything I could do that you need help with? And ended up he did need help. He was working on the 3rd edition of his book. And so one thing leads to another. I worked for him for this summer. I was supposed to go to Australia. I never go to Australia. Ended up taking a year off to work on the book and research. And just one project leads to the next project, led to a second book that I helped him write and did all the research for. So it was just sort of a snowball thing, but I committed to him and seeing as a very big mentor, but it was the exact right stuff I wanted to work on. So it was the right place, right time. You leaned into it, and it's been amazing.
So let's talk about that book. Let's talk about Stocks for the Long Run. Can you tell a little bit? I don't know if any of our high school students have read it yet, but it's very famous. It's one of those kind of canon books when we think of investing. Tell us a little bit about the book, and tell us about your connection to it.
So it's now in the 6th edition. I'm happy to say he added me to the cover of the 6th edition.
Congratulations.
With Jeremy Schwartz on the 6th edition. But the first project was the 3rd edition. So I started with him. He first published it in 94, and he had assembled the longest time series of data on stocks, bonds, gold, and the dollar. And what it showed was, for 200 years of data, the longest time series of stocks, was that after inflation, there's a number called Siegel's constant, which is after inflation, the real return to stocks was 6.7%. So 6.7 after inflation. Bonds over that very long run did 3.5%. So you had this, what's called a 3% equity premium, the amount that stocks beat bonds. Now, if you go over all the long-term time periods, his stocks were consistently at that 6.7. Now, the question is, will they do the same from here? Going forward from where you are today, will they do the same? And you'd say, no, things are more expensive today. They're not the same as they were historically. Bonds are more expensive. Stocks are more expensive. We could talk through all those things, but they're probably, the amount that stocks beat bonds over the real long run is probably similar today, even though both will have lower returns. But also, one of the things he says is stocks are so volatile in the short run. Day to day, you see things move a few percent a day, but over the long run, bonds have had a 30-year period where they declined in real purchasing power terms. After inflation, bonds declined over 30 years. Stocks never declined in purchasing power terms over 17 years. So because inflation is what we're all dealing with right now. The Fed's trying to combat inflation. We have a lot of inflation problems. Stocks were the best long-term inflation hedge. Bonds didn't hedge from inflation. You have a fixed coupon with no catch-up. Now there's TIPS bonds, what's called Treasury Inflation Protected bonds, which do actually make adjustments for inflation. So there's something different today than you could do over the last 200 years. but the yield on TIPS bonds today are 2.4%, when you could get what we think is closer to 6%, 5 to 6% in stocks today. So you still have that good equity premium, but it was really about the short-term volatility where stocks are the highest in the short run, but long run, perhaps the safest.
So our high school students who are joining us, I mean, obviously hopefully they're already trading, they're digging into the investment competition, they're thinking about these things, they're learning about these things, they're using all of the great resources that Wharton Global Youth offers, they're working with their teachers, but you just use a lot of finance terms.
Yes.
Right? So you talked about hedge, you talked about premium. How do you, what's a rule of thumb for students to start thinking about this vocabulary? How do they start speaking the language of finance?
Well, Stocks for Long Run is a good book. I think I did use a lot of terms. I think for stocks, there's a few key numbers. The PE ratio, the price to earnings, how much earnings you get for the stock. That's a key number. You know, when we talk about that 6.7% after inflation return, it comes from, when we say like, well, where did that 6.7% come from? The average P ratio, the price to earnings ratio for the market across time was 15. Okay, 1 divided by 15 was that 6.7. So that's the earnings yield. So the price, earnings over price, is a yield, and that's a very key concept. And then each one you just gotta you learn piece by piece. So you have this foundation for equity returns being the earnings yield for the market as a whole. This is not an individual stock level. This is market as a whole. And then you learn, all right, well, what do bonds deliver? How do you come up with those? Those are from the yields. And then the premium is just the difference between the stocks and bonds. You just got to get the foundation and go from there.
So the book is Stocks for the Long Run.
6th edition.
6th edition. Jeremy Siegel and Jeremy Schwartz on the 6th edition. Available everywhere.
Should be on all the major, on Amazon, on all the major places to buy a book.
So let's pivot away from that and talk about why we're here, which is ETFs. So as you've talked about, and as you know, as a professional who deals with ETFs with your work at Wisdom Tree, this year also we told you that the investment competition for the first time is encouraging students to learn about ETFs. In fact, we're requiring all students and all teams to include an ETF as part of their strategy and portfolio. So we're really excited to learn more about ETFs. But a sentence or two, describe ETFs, define them.
Well, ETF in its simple form is just a wrapper. It's a wrapper that will collect whatever basket of stocks, bonds, commodities you want to put into something. ETF stands for Exchange Traded Fund. So it trades like a stock on the exchange, but it's like a mutual fund because it is a basket or a collection of stocks. So they used to have to track an index, and I looked over the approved list. Mostly what you have on there are index funds, but you have some active funds. So there's a notable active fund has been ARK, so the Kathy Wood type portfolio manager, where she's been one of the high growth tech investors. But you have things like the S&P 500, which is the 500 largest stocks in the world, or 500 largest stocks in the U.S., weighted by market cap. And market cap is an important term. It's how the big indexes are weighted by market cap. Market cap is price times shares outstanding. Okay, so what does market cap do? As prices go up, stocks get greater weight in those indexes. Now, they never sell. They don't have a real sell discipline. They ride things up and they ride things down. Now, you could say it's got to be so much easy to beat that. But the reality is the active managers had a very hard time of beating the index. And, so that's what's called sort of passive investing. But it's not really passive, because it's dynamic. The weights change every day with the market moves. And so that there's that cap weight index comes through a lot of the places. You'll see some other things that'll be equal weighted. There'll be things for not just large caps. There'll be mid caps or small caps. There'll be sectors. There'll be countries. There'll be bond funds. So you got to think about what's the overall portfolio allocations you want, and there will be an ETF for it.
Excellent. So I want to remind everybody, if you haven't turned your camera on, we'd love to see you and say hello from here in Huntsman Hall in Philadelphia at the Wharton School. Also remind you that if you have questions, I have a few more questions for Mr. Schwartz, but if you have questions, we want you to put them in that Q&A panel and then our team will get them to me and we'll be able to ask. We can get your voices in this conversation as well. All right, so we're talking about ETFs, but you work at ETFs, right, at Wisdom Tree. So tell us, what does a day-to-day look like? Are you active? Are you an active manager in those ETFs? I mean, what does it look like in your work?
So at Wisdom Tree, I'm our global CIO. We have on the research team, we have about 30 people globally. We started off in 2006. We launched 20 funds in one day. And unlike market cap weighting, our premise at the beginning, this comes back to the Professor Siegel's work here at Wharton. His second book was all about value investing. It was called The Future for Investors. And it was in the aftermath. When I came here to Wharton, it was in 2001. When I first started working for Siegel, he was out there talking about tech stocks being in a bubble back then. And he was talking about how do you solve for bubbles? And we focused a lot on dividends, a lot on rebalancing. So our first 20 funds that we launched in 2006 were dividend weighted, and we would rebalance those portfolios once a year. But we've launched now 80 different ETFs. So we have ETFs that are rebalancing all the time. We have a set of indexes that are rebalancing right now, focused on the emerging markets. So we have a lot of the countries that are here will be in some of our ETFs that are highly traded. But so it really comes back to our team is looking at the ETFs, we're rebalancing them, we're always trying to improve them. We're writing commentary about what's happening in the markets. We do a lot of education with our clients. We're talking about the exposures, why they want certain things. So it's building, maintaining, educating, combination of all those things.
So we know that trading's volumes of ETFs have been very high. Why have they grown? Why have they become so popular? I mean, what makes them attractive to investors?
I think what people have found, let's take like technology stocks. Like, is it easy to know who the winners in tech are going to be? Can you pick the single stock? This goes back to that trading competition that you and I did when we were first doing. Picking the right stock is kind of riskier than say, I like tech. I just want to buy all the tech stocks, and you just get a basket or financials or energy. Hey, I think oil is too high or oil is too low. Let's not pick on Exxon or Chevron. Let's just buy all the energy stocks. And so I do think even the people who want to be active traders, there's less single stock risk in buying a basket. So the idea of buying a basket has dominated. So they don't want to take that extra level of diligence on the single name. They just want to express a theme. But for the market as a whole, I think the evidence has been, and this goes back to 30 years. It goes back to Jack Bogle from Vanguard, who was one of the first index investors. Siegel has been a known advocate for low-cost indexing. It's just, the evidence doesn't show the active manager after fees can beat ETFs. It's been just very tough. And so by and large, the ETFs have done better. Now, ETFs also, I sort of went through the tax efficiency point, but ETFs are for long-term investors, they're very tax efficient, the way ETFs trade and rebalance. Mutual funds and particularly the active funds who make a lot of turnover, but even if just reasonable amounts of turnover, in the mutual fund structure, they pay out more taxes, and people don't like paying taxes. They like to minimize taxes. So the ETFs have done very well from that perspective as well, being a very tax efficient.
So as part of the competition, we obviously focus largely on stocks. And for 10 years, we only allowed students to trade stocks, traditional equities. So now we have ETFs, both of which our students can buy and sell using our WIN stock simulator. How does ETFs impact stock prices?
So I often say, the ETF will reflect what's underneath it. And so now if there's a ton of money that comes into an ETF, you could say, well, that moved the needle on the underlying baskets, because people are expressing a view on those underlying stocks within the ETF. But there's a concept of, is the ETF trading at a premium or discount to what's called the net asset value of the fund, the NAV of the fund. And so let's say the NAV of a fund is 50. If the ETF is trading at 52, right, it's at a premium to the NAV or at a discount. And let's say the markets are crashing and the NAV of a fund looks like it's 50, but the ETF's trading at 48. And you say, all right, is there this big mispricing in the market? There's an opportunity. There's an arbitrage opportunity. And where that often happens in the bond market, actually, because the bond market is not that liquid. The stock market trades pretty well, but the bond market is much less liquidity, much less trading occurs in the bond market. And so during the pandemic, like right during the beginning stage of the pandemic, you would see a lot of volatility in the market, and people would say, oh, they're trading at big discounts. But the bonds weren't trading. The ETF was trading, but the bonds weren't. So I often just say the ETF is a very good reflection of reality. And there's some debate on both sides of this, but most likely the ETF is the right price because there's an arbitrage that could happen to bring the price back. And so, but if there's a lot of money that goes into any space, it could drive that space. But you got to say, is the ETF outsized volume driving a space?
So arbitrage, great word. Define arbitrage for us.
Arbitrage goes back to that NAV. I talked about $50 for the NAV. There's market makers who are trying to say, all right, I could buy the underlying basket at 50 and sell it to a client at 52. There's a spread. I'm going to make that $2 spread because I could buy the basket and sell the ETF. And then the market makers can work with the ETF company to create shares of the ETF. There's what's called an in-kind transfer. And so there's a group in the ETF community, what's called an authorized participant. The APs, as they're called, will interact with the fund company. So our fund company will deliver ETF shares to the AP. The AP will deliver the basket to the ETF company. That's how you see growth in AUM of the ETF. It's also what makes the ETFs very tax efficient is that in-kind swap. The selling usually does not occur within an ETF, but that back and forth in-kind transaction is the APs will try to buy the basket as cheap as possible and sell it to the buyers of the ETF.
Right. That's why we're seeing different impacts that happen instead of just buying a traditional stock.
Yeah.
Let's look again at that difference between research point of view. If we're researching a stock, right? So we're researching a stock, we're going to look at the company. One of the things we talk to young investors about, young investors get this advice all the time, buy companies you know. If you wear Nike.
Peter Lynch. It was a Peter Lynch phenomenon.
Peter Lynch phenomenon. Not a Wharton guy. No. So but right, buy what you know, right? You wear Nikes, maybe you want to buy Nikes. You know Nikes are doing really well. So you can research a company. You can start reading their financials, but you can also read just plain language. You can look at their marketing, read about their governance, read about their board structure, read about who they are. When you want to do the same for an ETF, how do you go about doing that?
Well, in some ways it's the same, but it's harder. Like,
right.
Again, the ETF is the collection of the stocks. You need to know what you're getting. I think for something as broad as the S&P 500, it's what's going to impact the overall levels of the market and the macro conditions. A lot of it is less individual companies. It's what's happening in the bond market, the Fed, inflation, all sorts of higher level things. But you could look at, we have a tool on our website. I encourage everybody to go to sign up to our website. You get more information as people going into finance as professionals. But there's a lot of information for everybody. And if you go to the tools section of our website, you can put in ETFs, not just our ETFs. So you can put in any of the ETFs that are on your approved list. And there's a whole valuation section on things that you would look at an individual stock at, like what's its PE ratio, what's its dividend yield, what's its profitability, how is it growing, the basket, and you can compare ETFs on that. And that'll give you a sense of sort of the long-term grounding in the fundamentals, the valuations, the growth rates, some of the sector exposures. And you could look at the ETF as its underlying. You want to get a sense of how are the earnings growing. If you have a tech sector, it's a collection of how are the earnings and valuations of that sector growing. So it's a little bit more macro, not as much on the individual company stories. But you can, I think ultimately, we're trying to help people evaluate it like they were looking at an individual stock too.
Excellent. Let's start talking to some students. We got so many great questions coming in here. Just a quick reminder, we'd love for you to turn your camera on. If you have just joined us, we'd love to see you, give you a wave, say hello from Philadelphia. Also encourage you to put your questions in the Q&A so we can get to those questions. So let's turn to some of those questions now. Our first question was from Arav, who asked, how does inflation impact stocks?
So inflation, I talked a little bit about the real return. I gave you the 6.7% was the after inflation return. I gave you bonds were 3.5. over the 200-year period. Inflation is, the cost of goods going up over time, right? So we talk about having an inflation problem now. Things are getting more expensive. When the cost of food goes up, when gas prices go up, that's inflation. Now, how does it impact stocks? Well, if companies' costs are going up, let's say they have to pay their workers more, that's a form of sort of cost inflation. Often what they do is they eventually raise their prices. So this is one of the reasons why we say stocks are a good protector from inflation, because companies take action. They pass along price increases they're facing on input costs, whether it's higher oil prices, they got to pay their people more. They eventually raise the price to you and I buying their goods. And so over the long run, the evidence shows dividends off of the market have increased more than inflation. So I show a chart often of the 70-year dividend growth on the S&P 500 versus inflation. Inflation's been about 3.7% over the last 70 years. Dividend growth has been 5.7%, so 2% above inflation. So companies grew their dividends faster than inflation. Now, we had a 2-decade period in the 70s and 80s where inflation was 6% a year. But dividend growth also beat inflation during the very high inflation period. So that's why I used the word hedge earlier, that stocks are good. They protect from inflation. In the short run, we often see in the short run when the Fed, the Federal Reserve is what sets monetary policy. The Fed is one of the big macro variables you got to respond to. They're hiking short-term interest rates. They're making the cost to borrow money more because they're trying to fight inflation. When the Fed first starts fighting inflation, it could be negative for the markets because they're making tighter policy. That's what happened last year. You had a big bear market last year as the Fed was starting raising interest rates aggressively. We weren't worried they're going to raise them too much, but actually they've held in. The economy hasn't collapsed more than you might have thought based on how much the Fed has been tightening rates. But the big picture is that cost pressure, companies passing on prices as the hedge to the inflation.
So to shift a little bit, Arian is asking us to go back to the earlier part of our conversation. How can we know when to choose between active and passive ETFs and mutual funds? You started by talking a little bit earlier about active and passive ETFs.
Yeah. I think the default has been to be an index investor. I mean, the default has been buy the S&P 500, buy the Russell 2000 for small caps or an S&P. We think Wisdom Tree's indexes are better, but you can buy the cap-weighted indexes. You have to really believe in the active. So you have to believe they have a skill set that will consistently beat the mark. So if you find somebody you believe in, you think they have a process, you got to sort of like to trust the process. You got to believe that they know what they're doing and that they can do that. And it's tough. You got to say that they can overcome their higher fees because they generally will be higher fees than the index funds. And but so if you find the right managers, like Warren Buffett, he got to manage a mutual fund, but he's been one of the greatest investors of all time for the last 70 years. And he's done it. Now, how many Warren Buffetts are there out there? Finding the right...
might be one with us today. Might be one right here on this board. We hope so. All right, so let's shift a little bit here now. And I really appreciate this question from Anissa, who shared, because as we mentioned at the start, for those who weren't with us, what we love about these Meet the Experts is this is another learning opportunity that Wharton Global Youth is happy to provide. And although everyone's in the investment competition, we're not here to give you an advantage in the competition, but to continue to broaden your understanding of business, of finance, in this case, ETFs. So Anissa asked about buying international ETFs and stocks. And how do you do that during times of political and economic uncertainty? You talked a little bit about inflation, but how do you make these decisions on when you should go in and when you should be safe?
It's a very great question. And I think there's opportunities and risks from all these situations. I think one of the roles international that I talk a lot about is the role of currency also. So the dollar is a big factor when you invest. Let's say you're a U.S. investor buying overseas. You have to think about the role of what is your currency doing. And for U.S., I think U.S. investors have taken too much currency risk. So I was actually one of the first firm to launch what's called currency hedged ETFs, which neutralize the currency impact. And people have thought it was expensive to hedge currencies, which is, hey, if I'm a U.S. investor going to buy Europe, I have to sell dollars, buy euros to buy the stocks. Now I have stock exposure and euro exposure. The question is, what if I just think the stocks are good opportunities and not the euro, which was what I thought 10 years ago. And the euro was at 160. Now the euro's at 104. So that was a good call. But you don't have to take the currency risk. I think so now there's people who want the dollar. So you might be in a market that has a weak currency. You say, hey, I want to go overseas because I want the dollar exposure. So you got to just be smart about currencies as you do that. That's one of the things I think a lot about. You got to think about the cost to hedge. The cost to hedge those currencies is based on interest rates. So right now, as a great example, Japan is like one of the hot topics of the moment. So the Bank of Japan is looking at 150 yen. Their currency is 150 yen to the dollar. Like 24 months ago, it was 100 yen to the dollar. So it has weakened a lot. So if you didn't hedge the currency, there's a huge difference in returns. Huge. Now the question is, will the Bank of Japan intervene because the currency is too weak? So all these things are things you got to think about. Where do you want your Japan exposure? Now I think one of the big topics in many of these is certainly you got the war in Europe. That's a huge problem. It drew up all the energy prices across Europe, and that had implications across the European economies. Now, if that gets worse, that could become things people look at to pivot, but also people are thinking about broad indexes for emerging markets and the tensions with Asia and what's happening in Asia. And there's all sorts of open questions about, how do you think about indexes? There's things like emerging markets ex China. There was Asia ex Japan back in the day. So there's all sorts of ETFs to carve up what you want. And if you want to isolate risks or not have risks, there's things to do that.
But so what else I'm hearing you say is that when you want to do this research, when you want to think about this, when, to come back to the question that was raised on this idea of understanding political and economic risk, is you have to read all the news. You're not limited. I mean, you talked about when your dad bringing you to the stock tables that used to be in the newspaper. If our students want to read the news, it's not just a business section.
Right. When you go towards ETFs, you are thinking the big macro. You could focus too much on the news, right? From a long-term investor, if I go back to stocks for long run, you could buy one ETF and be done. You could buy the all world.
That's right.
You could buy all world and not do anything.
Okay.
So that's one simple way of doing it, right? And that's as passive as it gets. You don't need to be too fancy, but everybody likes to try to make decisions, right? So you can say, I want to overweight the US, I want to overweight Europe, I want to overweight China, Japan. I love Japan, but those are the kind of things you can decide where you want to go, but you can make it simple. You don't have to read any news. You can just buy the all country world index.
Okay. So let's get to a little bit more technical research though. And you mentioned your site, which is Wisdom Tree.
WisdomTree.com. We have a place for US investors, and check out the tools. Check out the link for strategies. On the strategies page, I have a daily report that gives all sorts of information across the markets. We have a blog that puts out content on a daily basis. So there's a lot. Definitely go through the tools page. It's called Fund Comparison. Is the fund comparison tool. There's commentary from Siegel that goes out every week. If they don't want to listen to the podcast.
Other favorite sites for researching ETFs? As our students prepare for the competition, have to make decisions. Other sites you'd recommend?
In terms of ETF diligence, I mean, most of it is you got to find the market you want. So it's less about the ETF because the ETF is pretty simple. It's the wrapper. So you need to decide what segments of the market you want. And so the major ETF companies will have good research. So BlackRock, if you go to BlackRock.com, they'll have a lot of great insights on where do their experts think you should be in the US or what sectors they like or not. So a lot of it is positioning, and you'll find the ETF to do it. There's not a lot of nuances, actually. The ETF is pretty simple. It's just the basket. So it's really about what segment of the market you want. So I'd encourage more some of the big provider sites, find the content, find what thing's going to help you make the allocation decision, and think high level more so than just about the ETF.
We'll get some technical questions. Are you ready?
Great.
So Joseph asked, what is your opinion on free cash flow yield?
what's interesting, there's a group of ETFs called from Pacer called cows, like the cows ETF. So they're focused on free cash flow. And they've done pretty well. It's there's all sorts of ways of measuring valuation. And we have focused a lot on dividends and earnings, but free cash flow is a very good way of looking at valuation, and it's just a way to judge how much you're getting for the price you're paying. I talked about price to earnings as one of those variables, but free cash flow is another one that people use quite often, and so those ETFs have done quite well.
Staying with some technical questions, Dominic is asking, is a longer one, considering the PE ratio of multiple major indexes higher than their historical averages, would you consider the market overvalued? If so, how can we exploit this without the ability to short?
It's interesting. I touched on this a little bit, that with my comments that the long-term return for stocks was 6-7, I thought the going forward return was 5-6. In the fives, it was 5 to 6. It was more expensive than normal, but actually not dramatically expensive. And particularly, people have been worried that bond yields are now so much higher. The last 15 years, bond yields were like 0. So there was no competition for stocks, and that helped support stocks because bonds were just so bad. Now, bonds are more competition today, but it doesn't mean stocks are a bad deal today. You actually can follow me on Twitter. I do a lot posting on Twitter as well, at Jeremy D. Schwartz. I actually did a thread on this one today about tech stocks and how there's also some accounting that a lot of the companies today, if you go back historically, people would build a plant, they'd put an asset on their balance sheets, and they would depreciate it over, say, the next 5 years. When you depreciate an asset over the next 5 years, you make a big investment. You're going to build a plant for, let's say, $1 million, but then you expense it.
Right.
You spend the $1 million, but then you put $1 million on your balance sheet, and then you depreciate over 5 years. So it only hits your earnings $200,000 a year over the next 5 years. These tech companies are making a lot of investments today and expensing it immediately.
Oh, wow.
And so there's a statement that there's what's called accounting for intangible assets. And if you capitalize all the R&D these tech companies are doing, this is a lot of tech. This is very high end. This is like accounting 102. But if you account for all these things that these tech companies are doing, the valuations are not quite as high, actually. And it actually could say that it's 25% lower than their stated number. So, and it could go from saying these tech stocks are wildly overvalued and call it 50% more expensive than the market to maybe only 25% more expensive than the market, and they're growing much faster, so they're worthy of that. So this is not a small issue for this accounting for the intangibles, but I'd say in general, we're not wildly considering the market's dramatically overvalued. We think the market's fair value at around 18 times. We actually see 20 is a fair multiple for the S&P. We're selling around 18.5 next year's earnings, which is reasonable. The big question is next year's earnings going to be maintained? Like if we have a recession, can we have the next year's earnings? So that's a big question.
There's our economic uncertainty.
That's the big question.
Right.
That's the real big question is the Fed going to throw us in a recession, earnings collapse?
Okay.
But if we took the earnings at fair multiple at face value, we'd say the market's not too expensive.
Okay. Staying with our technical questions, which we love because here we are at the Wharton School and we like to really push our high school kids. We know that our high school kids do great work and really dig into this. Tristan has asked, what liquidity risk metrics should investors analyze before investing in esoteric ETFs? I would love to know what you consider esoteric.
Well, this is a great question we get asked all the time launching new funds. When you launch a new fund, you don't have inherent buy and sell volume all the time. So people say, can I trade an ETF that doesn't show a lot of volume on the screen? The ETFs on your list show a lot of volume. So they trade, you don't have to worry. Now, I'd still say you should do limit orders. You really never should do, it's very rare that you should do a market order. A limit order is the type of order where you set the price you want to transact at. During, high volatile days, you can see wild prices. So we still always encourage you to use limit orders, make orders. But the reality on an ETF is you can know the price, that net asset value that I talked about, the NAV. there is this arbitrage that can occur. So the ETFs don't really trade far away from their real price. So if you can find what the NAV is, you can put an offer that's right around the NAV, and you'll largely get the price. The liquidity is there. This is one of the things I'm always educating my clients. You can get the liquidity if you know how to trade. You don't have to be scared about low volume. What you have to worry about was, and it's not even a worry, is will the issuer close funds? Like we announced some closures, 5 funds that we're closing. Okay, but you're going to get your money back. You're going to get your NAV back. You might face, if it's a low volume fund because it didn't raise enough assets, you might have to pay tax. If you have a gain, you might have to pay a tax earlier than you wanted to.
Right.
But that's the real risk. The liquidity, if you're smart with how you trade, if you use limit orders, you'll be able to get the liquidity generally, 98% of the time.
Let's find one more question from our students. So we have time for one more question from them, and then I have a final question for you as well. Kevin has asked, for ETFs, what are your recommendations for trading ETFs with tracking error for emerging markets, where there isn't a lot of trading activity? So again, we're back to this question of volume.
It does go back to a lot of these markets aren't open when the U.S. is open. So like Japan is the perfect example. China is a good example. Australia is a good example of countries that are not open during U.S. hours. So what does the ETF reflect? It reflects what's called a future. It's trading as a future of like, what will the Japan market do the next day? So there's always been a futures market as sort of another way of trading indexes. But the ETF is trading in anticipation. So it's just sort of an extended trading of the local market. So tracking error, you have to worry about the long-term tracking. You want ETFs to track their indexes, but generally they do. I can give you an attestation. Generally, if you have a BlackRock ETF, a Wisdom Tree ETF, we're going to do a pretty good job of tracking the indexes. That's not the major concern. They do a pretty good job. Some will do better than others, the lower costs. They generally, there's some sampling of portfolios where you don't own every stock in an index. And so there can be some drift, but that's not the big picture.
Okay. I have a final question for you, a real quick one, as we have a couple minutes left. But I want to remind everybody who's joining us today, you can follow Jeremy Schwartz on Twitter.
Jeremy D. Schwartz.
Jeremy Schwartz. Now it's a high school audience. Are you on Instagram?
Not on Instagram.
Not on Instagram. Okay.
Twitter.
All right. Well,
I still call it Twitter, not X.
Still call it Twitter. Okay. But I also want to encourage you to subscribe to Mr. Schwartz's Behind the Markets podcast from SiriusXM, Wharton Business Radio. Podcast available once the podcast come out.
The show airs live on Friday, usually by Saturday, 4:30 Eastern in the morning. It usually drops in podcasts.
Excellent. So please, Behind the Markets podcast on your favorite podcast provider. We heard about the Wisdom Tree website, which is wisdomtree.com. Wisdomtree.com with some great information on it as well. All right. My last question, I'll leave the technical aside. One of the things that I love about ETFs is some of them have great names, right? So MVP is a group of sports businesses. It follows, right? A favorite named ETF?
Favorite?
Technical aside, whether it does well or not, just a great name. A ticker symbol.
Yeah, of ours, I like EPS for like earnings. We use like one of our earnings.
Good what?
On this list, I'm looking through the list that you guys had. That cows ETF for the cash cows. That's a pretty good one. That's one of my favorites on your list here.
Excellent. All right. Well, think about what your favorite one is. We look forward to seeing your reports. We look forward to seeing your teams work so hard over the next couple of months and submit to us for the competition. I wish all of you the best of luck in this year's Wharton Global High School Investment Competition. Please join me in thanking Mr. Jeremy Schwartz for joining us today. I hope you all enjoyed the conversation. Stay tuned. We hope to have other programming for you here from the Wharton School and Wharton Global Youth Program. Thank you so much. Have a nice evening. Enjoy your day if you're just getting started. We'll see you soon. Thanks so much, guys.